Welcome to The Explainer. Today, we are cracking the code on the Federal Reserve's latest minutes. We've been hearing Fed governors sound, well, a little nervous, which in their language can be a pretty big deal, like they're worried about losing control. We're going to dive deep into what they're really saying and how you can spot the key signals that the pros are watching, including one specific word that could change absolutely everything.
Okay, let's just get right into it. When a Fed governor says they're nervous, it is nothing like you or I saying it before a big presentation. See, the entire job of a central banker is to project calm, confidence, and absolute control. So when a word like nervous slips out, it's like a crack in the armor. It's a huge tell. It's a sign that the secret data they're looking at behind the scenes might be making them sweat. And their usual playbook, well, it might not be working.
And that is our mission today. The financial news will give you one story, and it's usually the simple one. But the real edge, the real alpha, comes from knowing how to translate what the Fed says into what it actually means for the economy and for your portfolio. So together, we're going to go from being reactive headline watchers to proactive code breakers. To break any code, you have to learn the language first. And believe me, this is a language. They call it Fed speak for a reason. It is designed to be technical and vague so they don't accidentally send markets into a panic. But underneath all that jargon are some pretty simple and really powerful ideas. Let's start with who's doing the talking. So these are the 12 people who meet about 8 times a year to literally decide the fate of the U.S. economy. They have 2 main jobs, what's called a dual mandate from Congress. Keep prices stable, so keep inflation in check, and keep employment as high as possible. It's this constant, delicate balancing act. And because of that, every single word they publish is put under a microscope by traders, looking for clues about which way they're leaning. This slide right here really gets to the psychology of it. Think about it. No Fed chair wants to go on TV and say, we're printing trillions of dollars, because that just sounds, well, reckless. Instead, they say we're expanding the balance sheet. It's more professional, more neutral. Tolerate liquidity friction. That's a really interesting one. It basically means they're okay with some banks struggling a little bit, that it's a necessary pain to get the system back on track. And my favorite, data dependent. That's the ultimate get out of jail free card. It means they have no idea what to do next and they're just as confused as everyone else. Knowing these translations is your first key. Okay, so now that we have our Fed speak decoder ring handy, let's use it to bust the single biggest myth that trips up investors. I mean, you hear this one repeated so often on TV, it's just accepted as fact. The logic seems so simple, right? The Fed cuts interest rates, it gets cheaper for companies to borrow money, they can expand, and stocks go to the moon. We hear it constantly. The market is rallying on hopes of a Fed rate cut. But here's the thing. That simple, tidy logic is usually dead wrong. Here's the crucial question you have to ask. Why is the Fed cutting rates? See, they don't cut rates when everything is awesome and the economy is booming. They cut rates because they see trouble on the horizon. Unemployment is ticking up. Growth is slowing down. Something looks like it's about to break. So the rate cut isn't the start of the party. It's the fire department showing up because they smell smoke. And by the time they actually announce the cut, professional traders have seen it coming for months. It's already priced in. The real question isn't if they cut, but if the cut is going to be enough to stop the very recession they're worried about. So if we can't trust the headlines about rate cuts, what can we trust? How can we see what the market has already figured out? Well, lucky for us, there's a tool for that, and it's totally free. Okay, this is one of the most powerful and freely available tools on the internet for this stuff. It's based on something called Fed Funds futures contracts. Just think of these as a giant betting market where big institutions are placing huge bets on where interest rates are going to be in the future. The FedWatch tool just adds up all those bets and shows you the consensus, the probability the market is assigning to what the Fed will do next. It's not a survey, it's not a guess, it's where the real money is actually going. And this number just illustrates the point perfectly. This is from a real meeting in the past. Days before the official announcement, the market was already giving a 98% chance of a specific rate cut. So when the news finally broke, was anybody surprised? Not at all. The quote-unquote news was ancient history to the market. The real price action, the big moves, had already happened in the weeks leading up to the decision, not on the day of. All right, so we've translated the secret language, we've debunked the biggest myth. Now it's time for the main event. This is the most powerful tool in the entire toolbox. If you want to know what the Fed and the big money traders really think about the future, you don't need to listen to a single word they say. You just need to look at one single chart, the yield curve. Buffett absolutely nailed it with this one. Every single asset, stock, house, a piece of art, you name it, is ultimately valued based on the risk-free interest rate you can get from the government. So when that rate changes, the gravity for the entire financial universe shifts. And the yield curve, that is the best map of that gravitational field you will ever find.
Now, don't let that definition scare you off. All this is a simple graph. On the bottom axis, you have time. 3 months, 2 years, 10 years, 30 years. On the side axis, you have the interest rate the US government pays you to borrow your money for that amount of time. You just connect the dots, and the shape of that line, that's the secret signal. Think of these 3 shapes as the economy's body language. A normal curve just makes sense, right? You should get paid more interest for locking up your money for 30 years than for 3 months. That signals a healthy, growing economy. A flat curve is like a yellow caution flag. The market's getting nervous. But the inverted curve, that is the big, flashing red alert. It means you get paid more for a short-term loan than a long-term one. This has predicted nearly every single US recession for the last 50 years. Before the dot-com bubble, before 2008, before 2020, the yield curve inverted first. It is the market screaming that the Fed's current policy is way too tight and that a recession is coming.
And honestly, that's it. This simple 3-step process is your new playbook. You can pull up the daily yield curve for free on tons of financial websites. So instead of waiting for some pundit on TV to tell you what the Fed is thinking, you can see the signal for yourself in real time. It's the difference between hearing the weather report and just looking out the window to see the storm clouds rolling in.
So now we get to the final and maybe the most important piece of this entire puzzle. We've learned how to decode the language and read the signals, but what is the actual risk that we're trying to manage here as investors? It's probably not what you think.
Here's the thing. Markets are actually pretty good at handling risk. What they truly hate, what they cannot stand, is uncertainty. Think about it. A Fed meeting is what we call a known unknown. We know it's coming, it's on the calendar, we just don't know the outcome. And that suspense, that period before the announcement, that's when anxiety and volatility just go through the roof. The real danger isn't the final decision, it's the waiting.
This is such a critical shift in mindset. You know, the daily ups and downs, the volatility, that's just the price of admission. That's the ticket you have to buy to get the long-term returns the stock market can offer. If you can't handle a big drop without panicking and selling everything, you're playing the wrong game. Your goal isn't to avoid volatility. Your goal is to avoid making a terrible decision during that volatility that turns a temporary dip into a permanent loss of your capital. And that's the brutal truth of it. Once the Fed actually makes its announcement, hike, cut, pause, whatever, a massive amount of that uncertainty just vanishes from the market. Even if the news is bad, the market can finally price it in and move on. The most dangerous time is the week leading up to it, when the rumors are flying. That's when traders are combing through the minutes for one keyword, a word like symmetry in relation to their inflation goal. If that word disappears, it's a huge signal they're getting aggressive. If it's still there, they're staying the course. The volatility comes from just not knowing. Once the minutes are out, the uncertainty is gone. And in the end, that's really the choice, isn't it? The headlines will always give you a simple and often very misleading story. But the tools we've talked about today, translating Fed speak, using the Fed Watch tool, and most of all, watching the yield curve and scanning for those code words, they give you a direct window into the gears of the market. They empower you to make decisions based on signals, not on noise. Thanks for joining us.